Well, the U.S. stock market took a nosedive in the red to close off the trading week, and it was all sparked by fears of an incoming recession. NewsNation's Alicia Nieves is live in New York City. So, Alicia, how is Wall Street reacting to this disappointing July jobs report?
Yeah, good morning, Kelly. We are seeing obviously a bit of concern over the economy following that jobs report. Another key data and headlines that have come out this week. Wall Street kind of being the first to be concerned here, panicking a bit as investors sold off at the end of this week. I want to show you actually where major averages ended up at the end of the session yesterday. We saw the Dow pull back pretty dramatically, about 1,000 points being shed there. The S&P 500 lower this on Friday by about 2.5% for the week. And then the tech-heavy NASDAQ, that was also hit the hardest, lower by almost 4%. The NASDAQ, I'll note, moving the most, mostly on news from Intel that it's going to be laying off about 15,000 workers. And this comes after a broader tech layoff we've seen this year, right? 60,000 people in the sector losing their jobs. Part of the reason I'll say really quickly is because when it comes to tech companies, they require a lot of growth and innovation. That requires capital investment, aka money, aka borrowing. But interest rates right now are so high that it's just not beneficial for most companies to do so. So they're having to shrink, pull back on operational costs, which means pulling back on the labor force or laying off. Now, the reality is that the tech layoffs, they made headlines this week, but the biggest headline came in what you noted, the jobs report. It really set in a panic on Wall Street and a panic more broadly that we added fewer than expected jobs on Friday. And it shows cracks more broadly in the overall job market. Unemployment rate, that hit 4.3%. That is the highest level in 3 years. So as you noted, striking fears of a recession potentially looming, and then certainly striking some concern and even criticism toward the Fed for its policy over the last couple of years to maintain interest rates at a relatively high level to hopefully tamp down on inflation. That's kind of the blunt tool the Fed has in its arsenal. But now we're seeing that medicine, if you will, or that tool, if you will, causing potentially more damage than good.
All right, really interesting, Alicia. So we've been talking all about inflation. Could this be a sign that the Fed has been looking for to finally cut those interest rates?
Oh, 100%. I mean, the Fed decided not to cut interest rates in July. Coming this upcoming September, the next time it would cut interest rates, it went from 0.25% potentially cutting to now the bet being it's going to cut about 0.5%. And that's going to be critical to try and stimulate the economy, try and stimulate, the job market. But remember, there's a lagging effect that happens when that happens. And so while it'll cut maybe in September, more than likely about 0.5%, it may take months before we actually see an impact. Kelly.
All right, great context. Alicia Nieves, thank you.
Thanks for watching. Go to joinnn.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.